This is Brian Rezny, president of Rezny Wealth Management, and of course the host of the Rezny Wealth Report TV show. We're here live every Wednesday at 6 p.m. and our program is rebroadcast at 7:30 on Sunday evenings. If you have a question about your portfolio, if you're concerned about an investment you own, maybe you're hearing about the markets being at an all-time high or there's a correction coming, maybe you're finding yourself being a little bit more emotional about your portfolio, or maybe you're finding the firm that you entrusted with your money doesn't actually have a legal obligation to work in your best interest. Call me with any of your investment questions about stocks, bonds, mutual funds. Maybe you want to get our free report, Fiduciary versus Suitability. You can go to my website for that. But call me in the studio. We're taking your calls. When you call that number, it's real easy. Call the number, give your question to a studio producer, and I'll take your question off air. I want to talk a little bit about kind of what we're seeing in the general economy. While we're seeing some improvements in the general economy, one of the areas that I'm finding very concerning is a lot of the retiree investors. In fact, if you look at statistics, a record amount of money has gone into intermediate and long-term bond funds. In fact, if you look at the last 5 years alone, over $1.4 trillion have basically gone into bond funds. Investors, retirees especially, falsely believe that bonds or bond funds are safe investments. In fact, bond funds can be your risky investment. Right now, what I've been warning investors, not only on my TV but also my radio show, is you need to watch out for your portfolio. What you think is safe could be the biggest risk asset you have in your portfolio, and those are individual, intermediate, and long-term bonds and bond mutual funds. Again, a record number of assets have went into these assets, into bond funds, $1.4 trillion. And what's interesting is as the market continues to hit new highs, investors over the same 5 years have taken out over $600 billion out of equity-based investments. So what that means is they completely missed all of that investment move. Why did that happen? I can pretty much tell you why. Number one is emotion. Number two, they don't have an investment strategy. And number three, the person they entrust with their money isn't actually a money management firm. They're actually a stockbroker or a broker or an insurance salesman that uses a title that is often misleading. This creates a big problem for you, the investor. And I can tell you this happens all the time. I do a lot of public speaking. I receive a lot of calls on both my TV and radio show. And there's a big misconception about what a real money management firm does and what your nice financial planner does. Most financial planners, stockbrokers, and advisors really are brokers or salesperson of investment products their firms represent. They actually are not under agreement to manage your money. That's why you never got that phone call, it's time to sell in 2000, or it was time to sell in 2008. You have what we call the pie-shaped set it and forget it portfolio, and unfortunately, that's been devastating to you retirees. There's better approaches. It's called a real investment strategy, which includes risk management, or when do you not own money in the stock market? When do you sell your bonds? When do you move more money into gold or sit on the sidelines in cash? That's all part of a real investment strategy. And if you've rode the stock market down twice in the last 12 years, or if the only time you get a call is to hold on, things will come back, or to buy a new investment, I can pretty much guarantee you you're working with a non-money management firm, and that firm is probably doing no more than selling you investments their firm represents that are often expensive and not the best thing for your money. If you've got a question about your portfolio, in the studio, 239-417-4711. One of the things I find often, I get a lot of comments when I do public speaking from not only clients if they come and hear me speak at events, but also non-clients. A comment I hear from a lot of retirees is, Brian, it's hard for me to make that change. I don't know what to do. The person I'm using is a nice person, but unfortunately they failed me not once but twice in 12 years. You've lost money. We realize change is difficult, so at Rezny Wealth Management we make it easy. Call our office number for a consultation. We have offices in Naples and in Fort Myers. Sit down with us in a non-pressure environment. We'll sit down. we could review your portfolio and we can help you better direct your portfolio for not only growth, but for safety of your retirement. I'm going to go to my first call. Chuck in Marco Island, Florida. My advisor wants me to buy a Pacific Life variable annuity. What do I think? Chuck, I'll tell you what I think. First off, never ever buy an annuity in your IRA account. That's number one. Number two, your advisor is a broker. Anybody who sells annuities, whether it's variable or whether they're fixed equity indexed or fixed annuities, they're earning commission on those annuities. So that means that broker is really a salesman. They're not an advisor at all. When you work with a broker selling an annuity, they're working what's called under the suitability. You're suitable to buy an expensive, mediocre variable annuity that is totally inappropriate for your IRA account, but that's going to line that broker's pocket the most. What I would tell you is this: you need to get a second opinion before you tie up your $700,000 IRA account in a very expensive variable annuity and lock your money up with limited access for the next 9 years. In fact, we had two individual, not only one client, but another potential client, just in the last few weeks come in. They both had Pacific Life annuities. We call them PAC Life annuities. They're amongst the most expensive of the variable annuity. In fact, many of their products are often run between 4 and 5% a year in internal cost structure. 4 to 5% every year coming against your return. They also, many of their products have 7, 8, and 9-year lockups of your money, meaning you have limited access without big surrender penalties. The investments inside these annuities, and not just Pacific Life, but almost all these variable annuities we've reviewed as an independent money management firm, are mediocre. And the only reason the investments show up in those variable annuities is because they're often sponsored because of revenue sharing. So the insurance company or the brokerage firm that develops this annuity, this variable annuity, the way that they pick those mutual funds, or those mutual fund sub-accounts, I should say, is not because they're good. It's because they get kickbacks from those companies that put those funds inside the variable annuity. So again, what I would tell you is this: high expenses, often 3 to 5% a year, come directly out of your return. That's horrific. You insanely lock your money up in these variable annuities, often for 9 years or longer. Mediocre, expensive investments, again, come against junior money. Your advisor is a broker. His interests are not the same as yours. In fact, it's legal for your broker and his firm to put his interest ahead of yours. Please do not buy that variable annuity. You will make the biggest mistake of your investing life by insanely locking your money up with little flexibility. I would ask you to call my office for a consultation. There's a big difference when you use a fiduciary money management firm that's fee only, who has none of these conflicts of Wall Street or these annuity salespeople. Please don't buy that annuity. You're going to make a big mistake if you do. If you're like my last caller, you have a question about your portfolio, you want a straightforward answer about your portfolio, call me in the studio, 239-417-4711. Tim in Naples: my advisor sold me an Apple REIT for $100,000. It's dropped 50% in value, and so has the interest. Can I get out? Tim, let me tell you what. We've received literally probably 200 or 300 calls on my radio show about Apple REITs. They were actually sold a lot on the east coast of Florida, which we also have offices. Apple REITs are what's called a non-publicly traded REIT. These things are horrific. In fact, a lot of investors put a lot of their hard-earned money into non-publicly traded REITs, not only Apple, but other REITs that basically turn out to be huge lemons. Brokerage firms manufacture and or sell non-publicly traded REITs because it lines their firm's pocket the most and pays the highest commission to their selling brokers. The problem is you bought a non-publicly traded REIT. No, you can't get out of it. You're stuck. That's why it's non-publicly traded. You took a 50% haircut on that Apple REIT, and you took another 50% decrease in the interest they're paying you. The SEC and FINRA have come down hard on David Lerner and Associates, who basically manufactured and distributed or sold these REITs throughout the country. Unfortunately, you made a bad choice. What I would tell you in the future is never ever buy any complex product like a non-publicly traded REIT. Do you know there's publicly traded REITs that are completely liquid? You can buy them today, sell tomorrow, that are well diversified, that pay better interest rates than non-publicly traded REITs, don't have any of the markups or commission or the conflicts that the broker who sold you that Apple REIT does. He probably didn't tell you that because, again, a brokerage firm and a broker or so-called advisor doesn't have a legal obligation to work in your best interest. They work under what's called suitability, not fiduciary. I have to go to a quick break. I'll be right back with your calls after this. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. And we're back. You're listening to the Rezny Wealth Report, of course, and we're taking your calls live. If you have a question about a stock, a bond, a mutual fund, maybe somebody unfortunately sold you an annuity at a free lunch dinner or a free lunch seminar, call me in the studio. If you want an answer to any of your investment questions, if you'd like to know if your firm acts as a fee-only registered investment advisor or under the fiduciary standard, call me. We'll let you know if they do or not. We'll also be able to tell you if the firm that you actually entrust your money has a legal obligation to work in your best interest. By the way, less than 10% of investment firms are fee-only registered investment advisory firms. That leaves the other 90% in a sales relationship, which puts them under suitability. Bill from Fort Myers. I have a $1.7 million portfolio. I am mainly in mutual funds and 2 variable annuities. My portfolio has done little in 4 years. What can I do? Bill, the first thing I would do is fire your broker. Bottom line is you're obviously not dealing with a fee-only fiduciary money management firm. Just because you have the variable annuities tells me right now you're working with some kind of broker or brokerage firm who might use a misleading title to deceive you. At the end of the day, variable annuities do not belong in your portfolio. They're highly complex, they're very expensive internally, and it robs your real return from your retirement. Your other portfolio, you didn't indicate where it's at, but at the end of the day, if your portfolio hasn't gone anywhere in the last 4 years, and you're looking at a lot of different asset categories and sectors up 30, 40, 50%, what that tells me is the quality of the advice you're getting is no advice at all. What I would recommend is you can call my firm for a consultation. We always deal with larger investors, usually account minimums of $500,000 and higher. We are a fee-only money management firm. We're an active money management firm, and more importantly, risk management is an important part of our investment strategy. Call our firm, get a second opinion. I know sometimes it's tough to break away that relationship that hasn't been working, but in your gut, you know you have to do what's right for your retirement. Change is always hard, but I can guarantee you this. It's easy to talk to our firm. I'll guarantee that you'll learn a lot when you come into our offices, and you'll be exceptionally happy with our service once you talk with us. Rob in Fort Myers, can you explain the difference between a brokerage account and an advisory account? Great question, Rob. In fact, very few people ever ask me that question. You either must have listened to one of my past TV or radio shows. We talk about this a lot. About 90%, this is my estimate, about 90% of investors, that's you who's listening to me right now, probably have what's called a brokerage account, okay? An advisory account is actual managed money. How do you know if you have an advisory account? First off, you would have had to sign an investment advisory agreement. Not a brokerage agreement, an investment advisory agreement. Investment advisory is managed money, meaning that firm should be working fee only. Unfortunately, a lot of the broker-dealers now offer fee-based money management, but unfortunately still has a lot of the conflicts of their brokerage relationship and actually could work against you and your money. you really want to look at their disclosure form, their Form Part 2 ADV, to find out if you have an advisory account or you have a brokerage account. What I'll give you is this free tool. If you go to my website, ReznyWealth.com, for free, on the right side of the homepage, we have a free report. It details fiduciary versus suitability, and it discusses exactly what you're asking. Advisory account or brokerage account. The biggest risk, and I want to repeat this, the biggest risk that retirees face is this big risk, which is fiduciary versus suitability. If you'd like to get a free copy of that report, go to my website. It's free. Go to ReznyWealth.com. On the right side of the homepage, you will see free report, fiduciary versus suitability. We help you uncover the biggest risk to retirees today. Barb in Naples, what do you think about sell in May and go away? Barb, that's a great question. One of the big buzzwords around a lot of these news programs you hear about on TV is the old saying, sell in May and go away. Supposedly, magically, the stock market goes down. If you sell in May, the stock market goes down, and you go back and rebuy in November. Bottom line is this. We've looked at tremendous amount of studies on this, whether or not an investor should sell in May in the stock market and go away. The conclusion is this. It's a 50-50. The market doesn't just drop 20 or 30% in May to November. Seldom has that ever happened in history. At the end of the day, sometimes it works and sometimes it doesn't. Typically, the sell in May are weak points in time where there's less volume in the market, and maybe the market goes down 1% on average. At the end of the day, liquidating all of your equity-based investments makes absolutely no sense at all. So sell in May is not an investment strategy. It's kind of like a buy and hold investor who thinks just magically buying a bunch of investments, holding it through thick and thin is going to make you money. That doesn't work either. Neither does sell in May and go away. What you want to do is you want to find a real investment strategy that actually helps you grow your portfolio, but more importantly, actually gives mechanical sell signals when you should be selling parts of your portfolio in order to protect it. So what I'm going to tell you, Barb, is this. Sell in May sounds kind of catchy, but it doesn't work in the real world, and you'll probably cause your portfolio more losses than good. If you're like my last caller and you have a question about your portfolio, call me right now. When you call that number, you give your question to one of my studio producers, and I'll take your question off air. This way it's a little bit more comfortable for you. I realize sometimes when you call the TV or when you're trying to change and you want positive change for your portfolio, it's difficult. A lot of the clients that we deal with every day at Rezny Wealth Management, the new clients that come in and our old clients, we realize it's hard to make the change in your portfolio. You've been with the same firm for 10 years. You have mediocre results. You're hoping for better, but at the end of the day, if you keep doing the same thing over and over and expecting different results, it simply doesn't work. Sometimes positive change is good for your retirement, and better yet, it's good for your portfolio. Call my firm for a consultation. We would love to sit down with you in a nice, friendly environment, either our Naples or our Fort Myers office. We can talk about your portfolio. If you're unsure what's going on with your portfolio, maybe sometimes you're a little emotional. Maybe you're realizing the firm that you entrusted with your money is really just a broker or a wolf in sheep's clothing. Call my firm for a consultation. There is a difference. We invite you to experience it. I'm going to take a short break. I'm going to talk more about the economy, and more importantly, I'm going to take more of your investment questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Do you know the biggest risks to your retirement and investments? One is entrusting your hard-earned money to someone who doesn't work in your best interest. The other is a lack of a detailed investment strategy to meet your goals. Both risks can be devastating, but both can be corrected. Rezny Wealth Management, fee-only money management. Don't settle for questionable investment advice. Call my firm for a consultation. There is a difference. And we're back. We're taking your calls live. Of course, if you have a question about your portfolio, you're concerned about your money, maybe you're questioning the advice you're getting, maybe, unfortunately, you went to one of these free dinner seminars. The steak was good, but the heartburn after that person tried to sell you the annuity, not so good. One of the things that I get #1 call on my radio show is about annuities. Do I like annuities? Absolutely not. The problem with annuities, all annuities in general, is simple. High expenses, you insanely lock your money up, they're highly complex, and it robs you, the investor, of real return. Before you get heartburn from the next free lunch seminar or the next free dinner seminar, make sure you ask important questions. Go to my website, download for free the Fiduciary versus Suitability Report. Use that report before you put your money down on the next annuity and your money's taken to the bank. Do what's right for your portfolio. Change is difficult. We realize that. But if you keep buying the same bad, expensive products from the same people who don't have to work in your best interest at the same free dinner seminar, you're going to get the same bad results. You're going to be sold down the river. Avoid annuities. Expensive, insanely locking up your money, higher taxes than you were led to believe, extremely high expenses, and often mediocre investments. They need to be avoided in your retirement. Ed and Sally in Naples. Do brokers and their firms receive extra commissions for selling house products? Ed and Sally, you bet they do. All brokerage firms, as a matter of fact, and I don't care if it's a small brokerage firm or one of these big Wall Street brokerage firms, almost all the brokerage firms create their own proprietary products. Whether those are mutual funds, structured products, non-publicly traded REITs, maybe annuities, they all do the same kind of business. Do they make more money selling their products or their house brand? They sure do. But that's not the only place they make more money, and your interests are put at the back of the line. If you go to any of these brokerage houses, people ask me all the time, why does my broker show me one family of mutual funds over another? It's not because they're better. I can guarantee you that. They're showing you one family over another because that firm gets what's called revenue sharing. The more money they allocate to one fund or one family over another, they get kickbacks. Yes, kickbacks in the form of revenue sharing. In fact, how do you know this? You can go to any website, Google brokerage account disclosure form. That's brokerage form, broker account disclosure form. Google it. Pull up the brokerage account form you signed up for. I can pretty much guarantee most investors have what's called as a brokerage account. You would have had to sign this disclosure. If you read this disclosure, it'll tell you exactly what I'm telling you. You do not have a fiduciary account, you have a brokerage account. Our interest may be different than yours. It actually tells you this in the brokerage agreement. It'll also tell you about revenue sharing and how that's conflicts of interest against you and your money. I would suggest investors firmly need to read these disclosure statements so you understand the difference. Advisory account, brokerage account, fiduciary standard, suitability standard. Go to my website, reznywealth.com. You can download for free the report for retirees. Your biggest risk we've uncovered. Fiduciary versus suitability. It's on the right side of our homepage. Download it, read it. It will be an eye-opener. I guarantee it. Rob in Fort Myers, do you like emerging markets as a sector? Any recommendations? Rob, great question. We get a lot of questions on emerging markets. We do like emerging markets, but let me tell you how our investment strategy works. At Rezny Wealth Management, we don't just buy and hold or do this Wall Street pie-shaped allocation. We do something called relative strength. It's our global tactical opportunity strategy. We actually rank all investment categories, not just emerging markets, but all investment sectors in a proprietary system. We own the top performing or relatively stronger sectors in a portfolio. When a sector falls off our top position, it's replaced with the next strongest one. So our sectors freely rotate into relative strength and we want to sell relative weakness. Relative strength has been a great way to look at how investments have performed and often is a good leading indicator on areas you want to be with your portfolio. Right now, emerging markets, some of them are relatively strong and others are not quite as strong. Under our investment management and financial guidance, you will sleep well at night, you will enjoy life, and you will have less stress over your investments. If that sounds like the kind of relationship you want with a firm that is 100% fee only, a registered investment advisor, meaning we are an active money management firm, which includes risk management, and we have a legal obligation as a fiduciary to always work in our client's best interest and put your interest ahead of ours, unlike Wall Street or insurance brokers or annuity salespeople. We work for you. There is a difference, and we invite you to experience it. I know change is difficult, and I know as we all get a little older, sometimes you get settled in your ways. But you have to ask yourself, did the investment person you entrust with your money, do they work in your best interest? Do they actually manage your portfolio? Did they reduce risk? What is their strategy in 2000 and in 2008? I firmly believe a lot of retirees are hurt because of false information and often not making those appropriate changes that your portfolio desperately desires and needs. Please call my firm for a consultation. We do have offices in Naples and in Fort Myers. It's a very easygoing meeting. We talk to you about your portfolio, we talk about your needs, and more importantly, we can discuss how to better effectively manage the growth of your portfolio, but more importantly, how we can help you control the major risk that too many investors have today. And I want to leave you with this little bit of a warning. Some of the safest investments now, specifically bonds, could be your riskiest asset. Rezny Wealth Management, money management without the conflicts of Wall Street and insurance salespeople. Please call my office for a consultation. There is a difference. We invite you to experience it. Visit my website, reznywealth.com, and please download that free report. Retirees, you need to read this. We uncover your biggest risk in this free report. Fiduciary versus suitability. I'll see you next week.